The terms of inflation and monetary politics are often heard today, and I'm going to give you in-depth view of both in this video. Inflation is described as a general increase of prices and services in the economy and is noticed, as Arthur Laffer puts it, by decreasing value of currency, in his case dollars, and by decreasing value of long-term government bonds. It can also be noticed by an increasing price of gold, which happens because people want to prevent losing their savings. Contrary to the common belief, gold still loses value over time, but it happens in a much slower pace than money. To be even more precise, gold is not an inflation hedge, since in the time of inflation the price of gold doesn't go up, but it is still a monetary inflation hedge. What that means is that gold is a hedge against largesse of central banks, meaning that if central banks print money, the gold price goes up. On the other hand, if central banks shrink their balance sheets, the gold price goes down, meaning it is a safe asset in terms of hedging central bank prolificacy. This is best explained by world-class economist Michael Howell. This statement alone can make you as a viewer overwhelmed at first, so I'm going to return to basics so that you can understand Howell's idea once you watch the video. At the first glance, inflation bears all the negatives, but the countries through their central banks encourage inflation on a yearly basis. Central banks have target inflation at around 2%. Now, why would the central banks do this if their main purpose is to preserve the value of currency and prevent its downfall? Central banks have the monopoly on giving out money, so they can set the main interest rate, called policy interest rate, which in turn drives all the commercial banks to follow the pattern. If the policy interest rate is raised, the commercial banks have their own interest rate raised, which in turn has negative effect on people who want to take loans in order to start businesses. When that happens, the whole economy slows, but the value of money goes up due to it being more scarce on the market. As you can imagine, this kind of decision is difficult to make because political parties know that they would lose the upcoming election. The reasoning for this is that the majority of people would not opt to choose political options that slow the economy, even though their long-term political thinking of breaking the backbone of inflation is far more important than those few years of stagnation. This kind of event is described by Jeffrey Sachs, a professor of economics at Harvard University. Sachs is an expert on stagflation, a term where inflation and economic stagnation happen simultaneously, and is famous for his book on the topic titled Economics of Worldwide Stagflation. Sachs also served as an economic advisor to Victor Paz at Censor in Bolivia and helped him to destroy the hyperinflation. In just 6 weeks, the inflation dropped from 25,000% down to 6% by implementing his orthodox model. The model included strict monetary and fiscal policy. In other words, the central bank raised policy interest rate to make the money more scarce, while the government reduced spending in the new expenses such as wage raises, while also dropping the regular old expenses. The main problem is that many states can't come to terms that their budget is too large for their economy, but refuse to cut it down because it would give them a bad name. Sachs claimed that Bolivian inflation was broken once the value of their currency was depreciated and when the budget deficit was cut. This in turn also explains why my previous thesis where restrictive monetary policy in turn means that central banks stop printing new money to cover the budget deficit, contrary to expensive monetary policy which does the exact opposite. Simultaneously with that, the government started the process of privatization, liberalization of trade, deregulation and tax reforms. To keep the newly controlled inflation in the country at a fixed rate, Sachs proposed three main ideas: reforming the social differences, ending ideological fantasies, and ending the regional differences when it came to economic prosperity. The social differences were to be in check through progressive tax, while also never having budget cuts in schooling and healthcare because those hurt the lower classes the most. This method would also be a part of the second idea because people would gain faith in capitalism if the state provided the poorest with dignified lifestyle, deterring them from extremist ideologies. The regional differences were to be ended through the means of state subventions, which were to be given to agriculture and small light industries that could be started relatively easy. Sachs probably insisted on lowering the social differences because if the new inflation crisis emerged, people would take restrictive measures much easier if they weren't living life on the edge of fiscal existence. The world has seen many other examples of political parties who wanted to evade restrictive monetary policy in order not to lose popularity, with the prime example being the Eastern Bloc during the Cold War. The socialist ideology didn't have any democratic measure, such as free elections or freedom of speech, so they had to prove their legitimacy through other means. The main one was showing that they cared about the working people and therefore financed worker loans for real estate, their holidays, health care, benefits to retirement and many others. From this topic came the two most important issues: socialist interest rate and the idea of full employment. Even though on paper the idea of full employment sounded great, it carried a significant economic downturn. Because everyone had to be employed, their work productivity didn't matter, so the state would end up with many people employed doing no significant progress which could bring profit to the company. Their number would sometimes even be larger than their counterparts and therefore drain the profit that was to be invested into the future of the company. As time went on, it caused most of the companies to lose track with competitors because they didn't have any money left to invest into modernization. This in turn led to even larger prices and the circle continued. The state economists knew this, but had to tolerate it in order to secure the ruling position. This led the communist states, such as Yugoslavia, to force the government commercial banks to cover the minuses created by the companies free of charge. That debt was then to be accumulated by the central bank, which printed the money that was missing caused by the whole process. The free market has shown this theory wrong through the Phillips curve. Since in the eye of the economy, the workforce doesn't behave like any other good on the market, it is simply much more elastic, so the workforce market cannot just be rid of the unemployed. The price of the people that are already employed for some time is always going to be larger, so in order to balance it out, the market has to have a certain unemployment rate. It is simply a price that must be paid. The Phillips curve simply concluded that the economy must settle on a fixed unemployment rate because that would also bring the fixed inflation rate. You can also better understand this term by looking at the word NIRO, non-acceleration inflation rate of unemployment. This line represents a point of equilibrium between inflation and unemployment where neither are in need of further change. In simpler words, the market always must do a trade-off between a certain unemployment rate in order to have an inflation under control. You can also understand the curve by seeing that with economic growth comes a certain inflation rate. The reasoning behind it is that high unemployment allows the companies to offer low-end wages, while low employment forces companies to raise wages in order to get more qualified workers. This then affects the entire market, forcing the entire price range to go up. The cycle is then completed and the economy has reduced unemployment and made progress in general, but by doing so caused the entire price range to go up, forcing the monetary mass to increase and therefore causing inflation. This monetary policy is often disputed in the world of the economy, so to bring better insight what that is, we must look to Henry Ford. Ford decided to raise daily salary of workers from $2.34 to $5 on January 5, 1914. This left Ford to spend half of his $20 million budget on workers' payment. The reasoning behind it was to maintain fixed rate of employment in his factories, since the quota of 13,623 workers needed to be filled by an annual employment of 50,448 workers. This meant that work fluctuation reached 370%, which needed to be drastically reduced. This was in turn achieved by raising the wages, which simultaneously brought down the labor cost per product unit and therefore reduced the price of cars. Ford Model T pricing went down from $585.9 in 1913 to $526.8 in 1914, only to reach the price of $214 in 1921. Ford's decision forced the other producers in Detroit to also raise their wages, leading to workers in the car industry to be kings of workforce. That workforce later unionized, with its paychecks remaining high, despite all the recessions that came afterwards. This story then coincides with the Phillips curve. To investigate further, economist Lawrence Summers decided to research the relation between stagflation and Phillips curve, which didn't have an answer to it. To understand it, he researched the trade unions in US and Europe. Summers concluded that the unionization process is much larger in Europe and that the worker fluctuation is much lower. The main point was that the standard unemployment rate was also much larger in Europe, despite of the monetary situation at hand. Furthermore, when the unemployment rate spiked in Europe, the employment of the workers was relatively low, which was in turn because there were no new workplaces open. The time that workers spent unemployed in Europe was also much larger, with the US in 1918 having 7.5% unemployment, with only 15% of that number of workers remaining unemployed for more than a year. Britain and France, for example, had that rate at 75%, while Germany had it at 59%. All in all, Summers concluded that the time spent unemployed became proportional to its percentage. Summers therefore made a theory called hysteresis, which was based on the idea that insiders of companies and their non-elastic behavior better explain unemployment rate than the basic supply-demand theorem. It also explains why unemployment remains high even when the monetary policy changes its course from time to time. Summers also theorizes that Margaret Thatcher saw this idea, and that is the reason why she spent her time as Prime Minister trying to destroy many trade unions. Now that we delve deep into this theorem, we come back to the second problem that countries like Yugoslavia encountered. That was socialist interest rate. The Communist Party deducted that interest rates on loans cannot scale with inflation because it would hurt the rising economy. For example, Jure Bilic said that Yugoslavia is the largest building ground on the earth. Therefore, higher interest rates would hurt further investments and slow the entire economy. What happened in reality is that the central bank had to fill in the monthly difference on each interest rate, causing it to drain its foreign reserves, which increased the inflation from month to month. What made it even worse is that the central bank at one point ran out of foreign reserve, causing it to print out the money which was missing to cover up the debts created by this type of interest rate. Free market doesn't have such policies, and the interest rate is formed primarily on the capital market, with the only state influence on it being policy interest rate. Now that we have seen such examples, it is again easy to hastily conclude that it is good to have policy interest rate high, but by having it too high it can hurt the exports. This is called currency appreciation, where country's currency value is being changed, in this case raised, with respect to other countries' currency. The primary cause is raising interest rate, which leads to much higher purchasing power of the domestic population, since their pay is more worth. The whole price range then proceeds to go down. This, however, is a double-edged sword, because the goods produced by the home country become more valuable due to the appreciation of the currency, leading to the goods being overpriced for the country that imports it. The opposite is called currency depreciation, when the interest rates are lowered, but it can happen in other ways too. For example, if a surge in purchase of foreign goods happens within the home residence, it will cause a surge in demand for foreign currency with which to pay those goods. This leaves the home currency depreciated, and simultaneously boost the exports because the domestic goods on the foreign market become cheaper. This furthermore has ties with the international market, so the domestic currency can depreciate if the domestic inflation rate fixes at a higher rate than in other countries for a certain period of time. Another example is a fixed rate of domestic currency being locked onto a foreign one. Many of the world currencies are locked onto the dollar, so if the dollar appreciates, the domestic currency will as well, leading to lower interest rates and inflation. This explanation can easily lead us to believe that the low policy interest rate is more beneficial, and it has in case been a thought of many administrations, with the most recent one being Obama-Biden. Their idea was that low interest rates stimulate the economy. However, if we delve deeper into the subject, we can see that low interest rates suppress mortgage capital money from coming into the market to fund new investment. This happens because more people are drawn into taking new debts to invest, leading to an increase of demand that raises the market prices. Also, negative interest rates push bond prices so high that the yield becomes negative. Another thing to keep notice that appreciation of the home currency doesn't necessarily mean a raise of your money's worth. For example, in August 2022, the dollar surpassed the British pound and euro, but the appreciation was only positive when it came to foreign currencies, not to goods and services. The price drop that happened simultaneously was caused by the fear of recession, leaving the investors to stay away from the capital investment, causing the demand to drop same as the prices. Once those prices hit the bottom, we are going to see a jump back of inflation that is going to fixate around 7% and stay around as such. From this arises another problem of having too much monetary mass from printing those percentages of inflation. We are going to catch up with that cash, but what truly matters is the level of money compared to the GDP, which inflation will bring back into the balance, and that is what has to be brought into balance, not the growth rates. Growth rates are determined by the stock of money and the level of output, and it takes a while to catch up. This brings us back to the original topic of having such measures which create tight money. Those in turn take its toll on the economy, so the central banks are opted to choose the 2% inflation, as it has been mathematically proven to be most beneficial to the market. It is simply put an equilibrium percentage chosen to balance out the output of money and other mentioned factors such as inflation and appreciation in the global capital market. To give that extra perspective, if the money becomes too tight in its goal to stop inflation, it drains the foreign reserves. Once that happens, the exports start to fall off, as I have previously explained, but another problem will arise. Black market of foreign exchange blooms. The way that Sachs dealt with such an issue when it came to hyperinflation in Bolivia is that he copied the exchange rate from the black market and proceeded to implement it as a stationary rate backed by the country. If the policy interest rate is too low, however, then the current amount of money cannot satisfy the need of the market and has to be printed out to compensate. These actions are of course regulated by the law and are not given justice in this oversimplified analysis. The central banks also have their own security lendings, which are used to regulate the interest rate. The idea is that the central banks buy and sell security lendings of commercial banks, which are in turn obliged to do so by the law in case they go default. The idea behind it is to regulate the price. For example, if the central bank buys the security lendings which have capital worth, its market price rises. That in turn encourages the commercial banks to give out more loans with lower interest rate in order to create and sell more security lendings. The key factor behind the commercial security lendings is that their capital worth is made with property bonds. This mechanism works the other way around as well. Policy interest rate also determines the amount of currency printed when it comes to trading with the capital market. If the amount of foreign currency reaches a higher total number of home currency and therefore demands the printing of the missing amount, the central banks sell security lendings. By selling them, it would lower their total price, causing the commercial banks to follow its lead by increasing interest rate. Now that we have covered the basics, we can look into the liquidity. As I have mentioned before, commercial banks hold long-term assets, such as house mortgages in central banks, but face very short-term calls to pay out liabilities, such as money out of the ATMs, for example. Those short-term calls are covered by the currency given by the central bank. Long-term assets are used in case of bankruptcy, where the liquidity is used to cover the expenses of the users. This, however, is also regulated by the central bank, which regulates the split of the remaining liquidity that came up onto the market after another commercial bank went default. The reason behind it is that the free market competition for that liquidity would cause the banks to try and outprice each other, which would in turn launch the interest rate through the roof. Now that we have covered the basics in this first part of the video, we can look into more detail. Many non-economists often raise the question, why fight inflation when the fight bears so many consequences for the socially endangered? The best detailed answer is provided by Sachs. There is no greater social expense like the one that inflation bears. High levels of inflation is a great unfortune for all societies. When the inflation rate reaches 450%, we can bear witness to the disintegration of society. Those expenses are then much larger than the cost of fighting the inflation. To give this quotation more meaning, Sachs tries to prove that consequences of fighting inflation, such as rise of unemployment due to higher interest rates in private companies, difficult situations for those employed by the state companies because of the budget cuts for their payment, lower general payment, shutting down of unproductive companies, stopping the scaling of paychecks with inflation, money being more scarce due to the higher policy interest rate, lower chances of getting a bank loan, more expensive loans, cut of social expenses that hurt the poorest, higher percentage of people hurt by the raise of commercial interest rate, state privatization that causes many to lose jobs in order to save the companies, and many other are still more worth than having inflation on a rampage. Sachs also points out that if inflation is not under control, populist groups and extreme policies will rise, leading to a complete disintegration of society. This is in fact backed up by many historical events, with the most popular being high inflation leading to the rise of fascism in Germany during the 1930s. We know what horrible consequences this regime brought, and of course that its rise could be contributed to many other factors, but rampant inflation is still one of the main causes. Another consequence that tight monetary policy brings when fighting inflation is a period of economic downturn. This makes total sense since it is more difficult for the economy to get loans, but the government must stay true to anti-inflation policy even if the quarter turns out to be negative. Sachs explained this with the following quote: "A firm stance must be taken. 450% of inflation is too much, even at the expense of slowing the economy. We must still go into the process of disinflation. If the government tries to chase too many reformatic ideas, for example lowering inflation while simultaneously growing the economy, it won't achieve neither of those." Now we have come to the most complicated part of Sachs's theorem, the international one. When Sachs became the advisor of before mentioned Paz and Censor, the foreign debt of Bolivia was 130% of its GDP. Over 10% of that GDP had to be secured to pay back the overdue interest rate of the debt. This happened because Bolivia went default in 1984, meaning that it couldn't pay back its foreign debt. This left Bolivia in a situation where it couldn't pay back its debts, but it also couldn't fulfill its obligations for its restructuring. Even if it wanted to, through great restriction and fiscal cuts, It wouldn't just undermine its own anti-inflation program because people would not tolerate such large social expense. In other words, the reformatic political party would just lose its majority because no one would support it. Simply put it, people will not tolerate all the fiscal cuts, lowering of wages and unemployment for the sole reason of servicing the foreign debt. Sachs knew this and turned to the commercial banks, whom he knew wouldn't just give up its money that was given to Bolivia through mortgages. Sachs then turned to IMF, which in turn agreed to make concessions toward Bolivia before the country reached the agreement with the commercial banks. Sachs also reached the agreement with commercial banks where Bolivia bought off half of its foreign debt, numbering $308 million, on the debt capital market. The pricing on the market was 11 cents for each dollar of debt. The negotiations for buying the other half of debt continued in 1988, and the whole process had foreign donations of $38 million. The idea behind Sachs's tactic was that Bolivia didn't have to pay off its foreign debt in midst of its own inflation crisis. During the tight monetary policy, the country had a surplus of income from foreign trade, while the other debt restructuring processes usually have the case other way around. When that is the case, the monetary policy usually fails, while this tactic eased the psychological consequences of the process by having the help come from outside via trade surplus. After his experience with Bolivia, Sachs concluded that countries with extreme amount of debt, which he called overhang, are not in a position to deal with its foreign obligations even if they wanted to. Sachs therefore claims that the inflation rate in such countries is inevitable and that commercial banks should find it in their best interest to help such countries reprogram its debt through the debt capital market. By doing so, they strengthened the position of reformatic policies. Sachs then proceeded to call out the big commercial banks of being in a position of free rider, which in turn means that they wait for the smaller banks to sell a part of the debt on the debt capital market, which then raises the price for the remainder of the debt that is unsold. So if a debt is sold at 35 cents for $1, its price will rise due to the rise of demand on the market. He also claims that banks force the debt equity swap, where they obtain rights in exchange for writing off a certain amount of debt. Sachs claims that this is not a good tactic for the overdue countries because it is, as he claims, process of buying off a debt that was sold multiple times on a secondary debt market. Now comes the important part of Sachs's theorem. If a country buys off a part of its debt on a ratio of $1 for 50 cents, it in turn pays 50% interest rate. This in turn drains the country's foreign exchange reserves and poses a greater deficit in the budget. This in turn makes the foreign debt into a domestical one and proceeds to create a great level of inflation. While this whole situation where international institutions, countries in debt and commercial banks cooperate seems very smooth, Sachs himself admits the flaws in his theorem. Commercial banks often refuse to reprogram their loans in fear many other debtors would follow their lead. Furthermore, buying small portions of debt on the debt capital market usually leaves the countries worse off because it buys off a small portion while the other part of debt just rises in its price. The solution for this problem is found in smaller interest rates posed by the commercial banks while simultaneously giving them rights to oversee the monetary reform in such countries. If the debtor isn't following the reformatic policies, economic measures should be taken against them. He finds the example of his theorem in Mexico, which brought down the inflation through monetary reform, and can expect the commercial banks to write off a certain part of its debt. When asked why banks would agree on writing off a part of the debt, Sachs replied, "Banks have to do it and will have to pay the price. They have given out bad loans and now have to cover up at least a part of that expense." Sachs also gives a great insight of how foreign debt can turn into inflation and become everyone's problem. Countries with too large of a debt will just stop paying it. They will have to because they cannot commit economic and political suicide. What Sachs tries to pose with this theorem is that foreign debts can in fact be a large factor in the rise of inflation. If the debt is large enough, it will start draining the money that the country has allocated to other activities such as infrastructure, healthcare, etc. This then leaves a country with a choice of either covering the external debt or the domestic obligations. Since it cannot do both, it is forced to print out the money that is missing, leading the country into the enchanted circle of inflation. To better understand it, if a country B has to pay 10 million for foreign debt and 5 million for domestic policies with a budget of 12 million, it is forced to print the remaining 3 million. Depending on how large the monetary mass is, this leads to a significant percentage of inflation that month. Now that we have explained international effect on inflation, we can turn to the actual solution to it. One of the best examples of fixing stagflation and overall economic crisis happened in the 1980s with Ronald Reagan in charge. Behind the success of this campaign was Dr. Arthur Laffer, a professor of economics at the University of Chicago and the University of South Carolina. Just to show how grand his reforms were, I will name some of the most impactful results. The average median income of household rose by 10%. The average pay rose by 75%. The GDP went up by 3.5% from 1983 to 1989, with a growth rate in 1984 being 7.2%. Unemployment rate went down from 7.5% in 1981 to 5.4% in 1989. Tax revenue went up by 4%, and the poverty rate went down from 14 to 12.8%. So how does one achieve this progress in a stagflation market? The first step was an increase of policy interest rate by Paul Volcker, Fed's chairman from 1979 to 1987. Volcker raised policy interest rate above the average inflation rate, which at time numbered 20% policy interest rate on the basis of 15% inflation. Higher policy interest rate made money more scarce because the commercial banks followed up by raising their own interest rate. This, as I explained before, made money much more scarce and in turn made it more valuable since it was harder to get. High interest rate discourage investors from getting cheap loans and therefore makes money more tight. To secure this position, Volcker even let the policy interest rate form on the market itself, meaning that it could go up over the fixed amount. Making money tight was the first part of Laffer's formula to fight inflation, with the second one being an increase of supply. This was in turn, as Laffer puts it, because inflation came about when the demand reached a higher percentage than overall supply on the market. This theorem was named Reganomics, or supply side. The idea itself isn't tied to left or right wing because it was originally backed by the Democratic Party led by J.F. Kennedy in the 1960s. Kennedy sought to increase supply by reducing taxes, which was then opposed by Republicans. The idea was reborn by Reagan and his Republican Party, but it even had support of some Democratic senators, later named Reagan's Democrats. To prove this point, Laffer claims that Clinton as a Democrat didn't differ much from Reagan when it came to the economy. This is further backed up by the fact that the slogan for his campaign was "It's the economy, stupid," and the other fact was that Laffer also voted for him. Also, Laffer went on to become an economic advisor to Jerry Brown in his campaign for Democratic candidate in the 1992 election. His campaign relied on the idea of replacing all taxes with business net sale tax and personal unadjusted gross income tax. This in turn meant that all of the taxes would be replaced by a flat and broad-based tax, with the fixed rate being around 12%. Laffer also acted as an advisor to Al Gore with his idea of carbon tax, where a new form of tax would be introduced on the fixed amount of fossil fuel consumption. The idea behind it was that companies would be discouraged from using fossil fuels by this tax, and that the market initiative would return to equilibrium by having personal income tax lowered. This was a state where both the market and the federal budget profit. Already here we can see Laffer's idea that the market would much easier regulate itself by Smith's invisible hand than by any other state measures. Laffer claims that taxes move the incentive rates of the market, with higher taxes lowering the business initiative, meaning that carbon tax would provide more benefits than any other state administration. Now that we have got politics out of hand, we can turn to the history of personal income tax. It was first introduced by Abraham Lincoln during the American Civil War in order to finance the Union. People with an income from $600 to $10,000 paid an income tax of 3%, while the ones above this bracket paid 5%. Income tax was repealed in 1872, only for it to come back in 1884 when the federal court rejected it. This process repeated multiple times because income tax was considered to be unconstitutional, until the 16th Amendment was implemented into the Constitution in 1913. Congress proceeded to raise the income tax, so people earning $20,000 paid 1% tax, while the ones with total earnings about $500,000 paid 7%. President Wilson raised the top marginal tax rate, the tax rate paid by the highest earners, by another 7%, with the rate rising to 77% by the end of 1918. The period that followed reduced the top marginal tax rate down to 25%, which created the economic boom called Roaring Twenties. That period ended in 1929 and 1930 with a smooth Hawley tariff, and the economy was made even more worse when Herbert Hoover raised the top marginal tax rate to 63% while simultaneously raising other taxes. Laffer claims that such tax raise slowed the economy down so much that it exploded into the Great Depression of 1933. Then Roosevelt's administration introduced the wealth tax and raised the top marginal tax rate to 75%, with that percentage going up to 94% by the end of 1945. It is worth noting that all levels of marginal tax rates went up simultaneously with the top marginal income tax, meaning that the low-end part of society also had an income tax raised. This will be shown in a graph in a minute. Those high-end taxes were then lowered by Kennedy's administration, causing the economic boom referred to as Go-Go 60s. This percentage fluctuated, with Reagan's administration lowering it significantly. Top marginal tax, or the highest percentage of income tax, went down from 50% down to 28%. From that time until now, top marginal tax never exceeded 40%. To give this tiresome list of percentages some backstory, I am going to explain the idea of Reganomics through the anecdote of Robin Hood. We all know the story of Robin Hood, who lived in the Nottingham forest, taking away all the property from the very wealthy travelers. When the traveler was poor, he was allowed to pass free of charge, while the guy in between those two fiscal positions got only some of his stuff taken. Robin Hood proceeded to go to the town every night and share the wealth he plundered to those in need. A beggar would get the money from the gold purse Hood has taken, while the average Joe got some of the coins to take his wife out to dinner. This, in rough lines, is similar how progressive taxes work. The story sounds great until we look at it from the global perspective. The rich would very quickly bypass all the ideas that Hood imposed by simply hiring guards, while the average Joe that worked as a trader had to pick a longer route in order not to lose a percentage of his cargo. By taking the longer route, Joe has doubled the expenses of his goods, leaving the people back in town to face higher prices. In the end, Hood was doing more damage than good to the average citizen, while the richest still remained intact. The idea of Reganomics is not very far from the story, with the main idea revolving against the progressive taxation. The reasoning for this is that higher progressive tax doesn't scale with total federal tax revenue, as rich find a way of sheltering their money. Laffer claims that instead of hiring guards, rich now hire lawyers that help them avoid taxes, leaving the increase of top marginal tax inversely proportional with the amount of average income reported by the richest. This can be seen in the following graph, which shows a relation between the highest progressive tax and average state revenue. The red line represents the highest percentage of tax, while the blue shows how much tax was paid. The x-axis shows the decades, while the y-axis shows the tax percentage. This graph perfectly goes to show the idea that top high income taxes don't necessarily lead to wealth redistribution and therefore creates prosperity. Left-siders in the economy claim that redistribution brings wealth from those who have too much to those who are in need of it. Laffer counters this idea with this graph and also reminds that wealth redistribution has serious consequences on the market. The whole idea of supply-side economy starts from the theorem that economy is based on the initiatives. Those initiatives can be positive and negative and are again explained by the story. If you were to feed the dog every day at the same time, you will know exactly where he will be in the future moment. If you replace the feeding process with beating, you can only be sure where the dog isn't going to be, but you sure won't know where it is. What Laffer was trying to tell us through this story is that high taxes bring negative initiative to the economy. High levels of marginal tax rate will in fact hurt the rich, but it will also take away their incentive rate. What that means is that high level of taxes discourage people from starting businesses because most of their earnings will be lost through taxes. The main idea of starting a company is to earn revenue after taxation. Laffer goes to describe it as the following. We tax people who speed to prevent them from speeding. We tax the smokers to get them to stop smoking. So why do we tax a person that wants to work? This also confirms the main slogan of supply-side economy. You can't tax the economy into prosperity. This can be easily seen in the following graph. The red line represents the initiative, which goes down when the top marginal tax goes up, while simultaneously lowering the average income reported by the top 1%, which goes down. With the lower percentage of top marginal personal income tax, the percentage of average income reported by the richest goes up, while simultaneously boosting their initiative to start companies. David and Christina Romer from the University of California delved deeper into this subject, researching at what rate the income tax starts to become inversely proportional with the business incentive. Their research concluded that an annual paycheck of $200,000 with a 57% tax rate just isn't worth it, and Christina decided to become a housewife. Also, if we were to return to the previous graph, we can easily see the periods of roaring 20s and go-go 60s, which both happened during the time of low top marginal tax rate. High progressive tax has another consequence that is crucial to inflation, and that is state budget. The rise of top marginal personal income tax caused weaker business incentives, while simultaneously causing the rich to evade such high tax rates through sheltering. Therefore, total tax revenue from the top 1% income earners dropped, which can be seen in the following graph. The blue line represents the top marginal personal income tax, while the red line shows the total tax revenue from the top 1% earners. From 1943 until 1983, a year when Reagan tax reforms kicked in, the average rate of top marginal tax was 80%, while the total tax revenue from the top 1% income earners fixated at 1.54%. The graph clearly shows Kennedy's tax cuts in the 60s, in which the top marginal income tax dropped, causing the total tax revenue to go up. Reagan's administration did the greatest leap when it came to the matter of lowering the top marginal personal income tax to 38%, causing the total tax revenue to rise to 4.4%. This trend didn't change much until today. Clinton's economic policy didn't differ that much, even earning Laffer's vote in the election, and the trend of high marginal personal income tax didn't ever return to the levels of World War II. The idea of top marginal tax rate being at 94% is today replaced with the top percentage being at 40%. This idea correlates with the fact that higher tax revenue is caused by a higher tax base reported by the top 1% that in turn is inversely proportional to the tax rate. This can be seen in the following graph. The blue line represents collected tax revenue from the top 1%, while the red line represents the tax base. They move together and are both inversely proportional to the marginal tax rate. Statistics that I have shown are probably the reason why Reagan's tax reforms found sympathies with the Democratic Party, who was largely against it. Some of the Democrats, however, flocked to the Reagan side and the tax reform went through. Then, late afternoon came word that the Senate has passed its tax bill, ours, 89 to 11. Then from the House, where all the chips were down, we won 238 to 195. We got 40 Democratic votes. On the final passage, almost 100 joined the parade, making it 330 odd to 109 or thereabouts. This, on top of the budget victory, is the greatest political win in half a century. Of course, there were other reasons for Democrats to support it, but to give the topic more insight, we are going to look at the incentive rate. Incentive rate, which is calculated 1 minus the tax rate, has a direct correlation with the tax revenue from the top 1%. This situation is shown in the following graph. The blue line represents the incentive rate, while the red one represents state tax revenue from the top 1%. Both of them are inversely proportional with the rise of marginal tax. When looking at the graph, you can see both roaring 20s, which was lowered by the New Deal, and then go-go 60s, that was lowered by the four stooges, Johnson, Nixon, Ford and Carter. Laffer refers to the named presidents as stooges because he claims that their economic policy was tax raises throughout their period in the White House. From what I've shown you, you can see why supply-side economic claims that wealth redistribution doesn't lead to economic prosperity and does the exact opposite. The reason why marginal taxes work the other way around is that they lower the business incentive of the rich, leaving the poor with less work option and lower pay. This is how supply-siders explain their thesis that the poor pay the true price of wealth redistribution. Laffer dedicated a small story to simplify this theorem. If a taxi business owner has to pay too high of a tax, he will just terminate his business, leaving the poor with no income or job. Such economic behavior takes its toll on the entire economy, so the general rate of GDP is lowered, as we can see in the graph. The thing is that the rich suffer through such difficult financial times much easier than the poor, again leaving the poor worse off. Laffer again describes such policies with a story. When the tax rate is 90%, the person spends 90% of his time thinking of how to evade it, while spending only 10% of his time focused on the business itself. When the top marginal tax rate stays at 23%, people have 67% more time to think of the ways to better his business. Furthermore, Reganomics revolved around deregulation of the business sector, which would lead to more job offers because it eases the business incentive. By doing so, the unemployment rate drops, while the poor have a greater chance of vertical rise. The idea behind it is that the poor who can't afford university education still have a variety of jobs to choose from. By working on those jobs, they will get on-the-job experience, leading them to higher wages and an option to become shareholders in the company or even one day start their own. Low broad-based tax rate and work deregulation would lead to a rise of job offers on the work market, allowing the poor to switch jobs because of such large percentages of competition. Supply side claims this as an argument to show that this is not a zero-sum game and that workforce and capital are indeed friends. They even used this situation in their logo. A rising tide raises all the boats. Professor Martin Weitzman from Harvard University became famous for researching the topic of fixed unemployment in the economy. He was also famous for being opposed to the supply-side economy, but still concluded that I don't believe that workers' rights belong on the same shelf as civil rights. For example, freedom of press. Every healthy economy which has a large enough supply of job offers, the worker will best assure his rights by having an option to choose another job. If an employer is mean to him, he can say go to hell and opt to choose another job. I think that this is the best option of having worker rights protected, much better than tons of work regulations that tell you what you can and cannot do. Weitzman was a proposer of shared economy, which was in terms somewhat similar to Keynesianism, but when it came to workers' rights, shared his thoughts with Reganomics. An example of low marginal tax rate and low corporate tax rate can be seen in Ireland. Ireland was one of the 4 poorest countries in the EU, often called pigs, standing for Portugal, Ireland, Greece and Spain, but its economy bloomed after its low tax rate attracted massive corporations. By lowering top marginal tax rate, it created a tax paradise and today proves to be one of the most developed countries. Now we come to the second part of supply-siders, and we will explain a thesis why wealth redistribution benefits no one during inflation crisis. If the government issues inflation relief checks founded by the marginal tax rate, it has 2 immediate effects on the economy. The first one we already mentioned, as it lowers the business incentive of the rich. The second one is that it lowers the work incentive of the poor, who need to work less since they are getting money practically for free. This in turn leads to less efficiency in the country's economy and paves the way that was created in socialism, which I explained earlier in the video. In the end, inflation relief check has 2 negative impacts: lowering the productivity of the employer while simultaneously lowering the paycheck of the worker. It has been mathematically proven that for a percentage of each unit of dollar distributed, you lower the percentage of average income in state. President J.F. Kennedy explained this situation with the following quote: "No American is better off if he had to pull another American down to get to that position." Laffer proceeds to claim that even if wealth redistribution reached the peak efficiency at 100%, the simple method proved that the average income is 0. The only thing that inflation relief checks would accomplish is lowering the percentage of supply and demand on the workforce market, while simultaneously lowering the efficiency and dragging the economy to the bottom. Abram Bergson, a Harvard professor who was also a staunch anti-supply-sider, proved this statement through his studies of socialism. While doing the research for his doctoral thesis, he collected hard-to-get data about paychecks in the Soviet Union and found out that total elite number in the Soviet Union numbered around 227,000, while the one in USA numbered around 238,000. The main fact that was compared was a paycheck above $50,000, and the results showed that being Soviet elite proved more beneficial than the American one. His research continued through collecting data about average income of households from 1972 to 1974. He found out that 10% of households with the lowest income owned 3.4% total share of income, while 20% households with the lowest income own 8.7% of total state income. On the top of the Soviet equality, the households with 10% highest income owned 24.1% of total state income, while the 20% owned 38.5% of total state income. That meant that the top 30% owned more than half of the income in the regime that was founded on the idea of equal pay through wealth redistribution. This data proceeded to show its form after taxation and was also compared to the stats of capitalist Sweden. The corresponding data for households with the same percentages of low income numbered at 3.5% and 9.3%, while the one for households with the highest income numbered 20.5% and 35% of total state income. By bringing forward this data, Bergson showed that wealth redistribution is more balanced in the capitalist Sweden than in Soviet Union, whose whole economic policy revolved around wealth redistribution. Bergson research continued with a method of marking GDP per single worker with the number 100, which was sourced in the USA. That number didn't include agriculture, since that area of economic progress is the one that is given significant subventions in all countries, but their methods differ largely. The source number of 100 was then compared to West Germany, where the number dropped to 94.1, in France to 90.7, Great Britain to 68.7, Soviet Union to 56, and Federal Republic of Yugoslavia to 33.9. The point of this research is to show how overgrowth of the welfare policy reduced the economy as a whole. Similar facts were seen by Ante Marković, Yugoslavia's last prime minister, who in February of 1989 remarked, "It is obvious that all the socialist countries suffocate in the crisis before them. There is not a single one we know of that was capable of solving the problem of efficiency and the problem of integrating the democratic system." Marković made an in-detail program of reform that were meant to solve the dying Yugoslav economy and revolved around free market, ending the state interference in the economy, creating a democratic system and pluralism, privatization of state-owned companies, placing managers in charge of the state companies that had previously no responsibility, liberalization and deregulation of the trade policy, low broad-based tax for the entire country, lowering the percentage of beneficial retirements, free price formation on the market, free banking system that is only supervised by the central bank, etc. If you want to know more about his reforms and how Yugoslavia deteriorated, you can read my paper with a link in descriptions. Charles Murray did a similar research in his book Losing Ground, where he concluded that large welfare policies, such as inflation check reliefs, in turn create larger poverty rates. He starts his research with President Lyndon B. Johnson's War on Poverty, which consisted of 59 welfare programs at state expenses of $132 billion. Despite those huge amounts of money, the fact that almost 12% of Americans live in poverty didn't change, and in fact even turned worse, especially in the young and Afro-American groups. Another fact that emerged was that more and more kids were growing up with a single parent, mostly their mothers. The reason behind it was that women were in a better position if they divorced their working husband and therefore earned the right for welfare checks. The situation was tearing apart the American standard of family and spending the tax money of the workers for single mothers who were then in a better position than they would be if they were to work. The neoconservatives of the time saw this fact and proceeded to claim that welfare state turned out to be an economical and welfare failure, with Glider himself saying, "It is true that we have a consistent percentage of 12% of population living in poverty, but keep in mind that the structure of those groups is not always the same. This proves that even in the bad part of society exists a certain level of social dynamics, like the fact that each person is responsible for his fate, a price that capitalism must pay for its economic efficiency." Another fact that supply-side supporters saw in this is that they were paying a huge amount of marginal taxes to help the poor through welfare programs, and yet those programs yielded no results. Reagan came with a greatness trust, and his policy of deregulation, free market, less regulated business, less government activity in the market, coupled with the idea of restoring traditional family values, and swept aside all the competition. This rhetoric doesn't mean that supply-siders just want to ignore the problems of the poor. Laffer claims that in the 21st century we shouldn't let anyone suffer of hunger or cold, and that we as a civilization reached a level of obligation to take care of people in such need. This, however, doesn't mean we give them COVID and inflation checks, but rather provide them with free food and shelter. This way the poor are taken care of, and there are no lowering of the incentive rate to work, which would in longer terms lower the economic efficiency and the standard of living. The welfare politics that the government can offer is a high paycheck, which would come to terms with low and broad-based tax that would boost the job supply on the market. Another tactic that supply-siders use is an enterprise zone, which are zones where neither the worker nor the employer have to pay taxes until the area stabilizes. This would be used by the government to boost economic growth in the underdeveloped areas. Another fact that might be wrongfully interpreted is that the taxes shouldn't exist. This is, however, not the case, since taxes are used to finance the government and its institutions. However, the taxation should be done in a way that the damage dealt with the last dollar taxated should be less than the benefit that happens by the same tax dollar. Each government that has a tax goal higher than this method should opt to reduce their tax policy, and vice versa. Another thing that the government must watch out for is to spend the tax revenue in a way that will boost the economy. This means that taxation should be done not to hurt any factors that are most vulnerable to it and would quickly disappear from the market under its pressure. In other words, the government must take care that its tax policy doesn't reduce the supply of the market while simultaneously collecting enough tax revenue for itself to function. This thesis is represented in the Laffer curve, famous for being a solution of stagflation in the 1980s. The x-axis represents the tax revenue that the government collects, while the y-axis represents the tax rate. Higher percentages of tax yield higher tax revenues, but it simultaneously reduces the business incentive and the amount of income that the richest report for taxation. The high amounts of tax represented with letters A and C yielded the same tax revenue as letters B and D with a low amount of tax. Now, why would you like to be at the point of A and C? The colored part of the curve represents a state in which tax rates give negative business incentives and therefore reduce total supply and demand of the market. What Laffer's curve is trying to show us is the closest answer what science can offer to a question of what is the best tax rate and best tax system. The goal of the curve is to show how low taxes causes a larger percentages of business incentives, which in turn lead to larger tax revenues. Another point was to show that higher incentives and market supply is caused by a lower tax, lessening the economy impact of inflation and Fed's raised policy interest rate. Now let's look to the situation itself. Reagan's administration took power in January 1981, but it took some time to implement the tax reforms due to legislation of the Congress. The reforms were then implemented in January 1983 when the top marginal tax rate was dropped from 70 to 50% and the personal income tax from 28 to 20%. By the June of 1984, the economy grew by 12%, which in annual terms meant a growth of 8% total. The next part of the tax cuts came in 1986, when the top marginal tax rate dropped from 50 to 38%, with the total percent being dropped to 28% within the next couple of years. The personal income tax was raised to 28%, but the number of tax classes became reduced from 14 to 2. This was a crucial step for fighting inflation. Even though Volcker's raising of the policy interest rate did the heavy lifting, without the tax cuts, the economy would endure it much more difficult. As I mentioned, a rising policy interest rate slows the entire economy as a price of controlling inflation, but the tax cuts countered this negative effect since it increased the supply of capital market flow. This counters the left ideas of giving inflation relief checks and raising marginal taxes to help with a situation that high interest rates cause. Laffer referred to that idea. If the demand for the product drops, what happens? Its price goes down. If the supplies of product raises, what happens with the price? It goes down. Which method would you rather have? Crashing the economy in order for the prices to go down, a way of Larry Summers, or my way, which increases the supply of goods and services and in turn leads to economic boom, which reduced both prices and inflation like we did with Reagan. He proceeded to say that inflation relief checks and raising of the marginal tax rate only reduce the economy further. High marginal tax rate reduce the business incentive, which in turn reduce the output of the economy and raise the prices further. Therefore, if the supply side of the anti-inflation policy is not met, not much will change by it. It leads to a situation where the price of goods for each dollar spent outweighs the price of each dollar earned. The base state intervention per supply siders is to increase supply of the market by lowering taxes. If we take a look at the following graph, we can see that high interest rates are reversely proportional with the rise of inflation. The graph that is shown is Dow Jones Index. When looking at the graph, you can clearly see the periods of tax cuts that boost its value. All of the previous mentioned economic booms caused by the tax cuts can be seen. Roaring 20s, Go-Go 60s, and finally Reagan tax cuts that skyrocketed the index after its almost 20-year period of decline. To give this method full perspective, we must look at the downsides it brought. Such factors were disparity that show that rich benefited more than poor, State tax revenue fell from 18.5% to 70.4% from 1980 to 1990. The budget deficit grew from 74 billion to 221 billion, while Laffer claims that this large growth of deficit would have been solved by the market itself. The idea was that the tax reduction would enlarge the percentage of business activity and the amount of taxable income, leaving the low marginal tax rate sufficient for the budget requirements. Britain Prime Minister Margaret Thatcher faced a similar accusation that the rich were getting richer in her supply-side economy. Her response was, "All levels of income are better off than they were in 1979. But what the honorable gentleman is saying is that he would rather have the poor poorer, provided that the rich were less rich. That way you will never secure the money for better welfare services." When it came to the topic of household income, Laffer responded that median household income was very weak before his administration and that it was stagnated below 50% for a long time. For its percentage to rise, supply-siders support the following: increase of jobs on the job market, education and economic growth. Left-side economic options also claim that high marginal tax rates reduce spending and demand, therefore reducing inflation. Supply-siders agree that high taxes reduce spending and demand, but it also reduces the supply on the market in general. That leaves the same amount of money with less things to spend on in the economy, which in turn skyrockets the price even further. The example for this problem is given to the oil industry, which cannot increase supply due to many regulations, leaving them with the only one option: raising prices. Laffer claims that this problem could be solved by letting the market regulate the course of action instead of the government. Laffer also referred to other leftist methods of dealing with stagflation, giving the example of Jimmy Carter. Carter claimed that inflation was problem number one and proceeded to solve it by reducing the max speed to 55 km per hour, recycling the air in the airplanes in order to reduce the spending on air conditioning, controlling the prices of oil drills, and introducing profit tax. Laffer claims that all of his measures to counter inflation made the situation even worse off and that the free market ideas that supply-siders proposed to fight stagflation proved its worth with their mandate in the White House. Laffer is also a staunch opponent of inflation relief bills because they do nothing except giving out the money that is not based on profit and therefore reduce the incentive to work. This then reduces the economic efficiency and lowers the chances of economic prosperity. Keep in mind that I have shown this idea in most detail because I researched it the most. It doesn't necessarily mean that I agree with everything they say, and I leave the interpretation of supply side to you as a viewer. The next great economist we are going to take a look at is Paul Krugman, a professor at MIT. Krugman is an expert on currency stability and foreign debt at developing countries. Krugman states that the world trade exists in a particular state where almost the entire world is pro-free trade, but even its greatest supporters enact certain restrictive measures. He studied such an effect in trade relations between Japan, European Community and USA during Reagan's presidency. He concluded that there is a significant disbalance of competition in this sector. Furthermore, he found that oligopoly behavior caused by a smaller amount of companies in some sectors use government subventions in order to gain larger profit. This was, however, causing significant damage to other companies in the same sector. His second theorem is about the Laffer curve being used to explain the situation of countries in crippling debt. His statement is the following: if the debt percentage rises, the chances of that debt getting paid back falls. This can then reach a point where they cannot be paid back at all. This then acts the same as a percentage of too high tax rate in the economy. This is why the creditors must think the same as the taxpayer. This theorem works in reverse as well, but this time it acts reversely proportional. If the percentage of debt goes down, the chances of country paying back the rest of its debt goes up. He called this graph debt relief Laffer curve. The x-axis shows the amount of debt, while the y-axis shows the amount of debt that countries can pay back. The point C shows a 45% incline on the graph, showing a trend where larger debts decrease the chances of paying them back. The second part of the curve starting from the point C and onwards, meaning points C, L, R and D, falls below the line of 45% incline. When we look at the point L, we can see that the chances of paying back rises because the line decreased the percentage of its incline. In simpler words, the line from O to L shows the price on the secondary debt market. What that means is if you buy $1 of your debt for 50 cents, its coefficient is 0.5. When the nominal debt rises in a percentage over the point L, it poses a larger debt for the country, so their value of debt falls in the price on the secondary debt market. So does that mean that creditors should write off some of the debt money that the country owes them in order for its price to rise on the secondary debt market? The graph clearly shows that if a creditor writes off a part of its debt, its value will rise on the secondary debt market, but its total value when paid off will be significantly smaller. That is why the creditors don't choose this option. They much often hope that in that country might find some resource-rich area, or that the resource they export suddenly rises in its price, enabling them to pay back their debt. This is how James Baker approached the debt crisis in Mexico in 1982. However, the debt was still overhanging and the debt crisis became even worse. So at which point do creditors begin to write off their debts? If we take a look at point R, it shows the larger percentage of the debt reduced the price of their debt on the secondary debt market. That forced the countries in crippling debt to not want to pay off its debt because it has no interest even if they wanted to. At this point, the creditors will write off a part of the debt because of their own interest. This correlates with Laffer's idea that lower tax percentages lead to a larger tax revenue. In simpler terms, Krugman advises the creditors to write off a part of the debt only when the country is in such large of a debt that it pushes it to the right part of the curve. He goes on to state that the commercial banks often try to transfer their risk of countries not paying back to the other international institutions like the World Bank. In simpler terms, banks risk by giving out loans to poorer countries. If that country pays back its debts and interest rate, the bank benefits. If they don't, the banks will try to solve the issue by working with their own government or international institutions like the International Monetary Fund or World Bank. This action then affects the secondary debt market. Now we will turn to a subject we already discussed earlier in the video, buying your own debt on the secondary debt market in order to fix the overall economy and inflation. Krugman suggests voluntary solution, but breaks down the method of buyback into two categories: cash or swap, which is essentially giving up the right of ownership in order to pay back the debt. We will first turn to the cash option, which again breaks into multiple categories: using your own money, which usually refers to foreign exchange reserve, foreign aid or external financing. The first thing that the country must watch out for is to not overdo the buyback on the secondary debt market, because the rise of demand causes its price to rise. Also, like we have seen in the previous graph, since the total percentage of debt goes down, its remaining price on the secondary debt market rises. This is caused because of the likelihood of paying back the country's debt increases, since it has a lower percentage of debt. If the source of buyback comes from external sources, it doesn't necessarily mean it will benefit them. There is a high chance that the creditors take the most of the profit. That is the sole reason why the question of involvement remains so delicate. If international institutions like the World Bank or International Monetary Fund or the richer Western countries take part in the process, the creditors know that their chances of getting their money paid back rises significantly. In these situations, the loans that they have given to the country rise in the price on the secondary debt market. This situation can in the end lead to more benefit for the creditors rather than the countries in debt who were the main target of the help. Krugman states that the commercial banks act as free riders in this kind of situations, calculating profit for each part of the debt they write off. In simpler words, their goal is to have the price of their loan rise on the secondary debt market, earning even more money. The second part we are going to explain is a debt swap, and we are going to explain it on the simple example of Mexico in 1987. Mexico issued government bonds based on their foreign reserve that was also guaranteed by the US Treasury Department with the goal of buying back their old debts. Mexico calculated that the bonds will cause a cheaper buyback of their own loan on the secondary debt market, but during the whole situation it was difficult to establish seniority payment, leaving the debt to degenerate into local financing of the buyback. After the entire story, Krugman concluded that creditors should allow buyback of the old loans on the secondary debt market only when the country situates on the right part of the curve. This is how their profitability comes into story. Furthermore, the buyback on the secondary debt market benefits the creditors only if the end result was the same as if they were to write it off. In the end of the story, Krugman concluded, same as Sachs, that the buyback of all debt isn't as effective as collective work of all the actors when it comes to the debt crisis. Debt equity swap also brings with it an illusion that is a simple way of bringing foreign capital to boost your own economy. Krugman proves this wrong with the example of Nissan in Mexico, which wanted to win over the entire automobile industry in the country. But the way they did it was by buying off Mexican debt on the secondary debt market. In the end of the transaction, Mexico was left with less foreign capital entering the country, while it simultaneously paid the investment by itself. Krugman therefore thinks that debt equity swap results in switching one form of the debt obligation for another. He also sees another trap in this option. The foreign investors that came into the country's economy by buying off their debt on the secondary debt market has multiple options. It can have a long-term economic interest for profit, but it can also sell its part of the ownership to the domestic companies. That means that a foreign company could buy off a debt for a huge discount on a secondary debt market and proceed to profit from it by selling it in its full value for the domestic currency. This also often involves a possibility of repatriation for a full amount of currency that was brought by profiting. This is called round tripping, and Krugman states that they are not so rare as we might think. There is also another trap hidden inside this process. In the capitalist economy, law dictates that the debt should be settled first to the creditors, and if the end result is bankruptcy, the last one to be settled should be the owners. However, when the foreign capital enters the country, the foreign creditors take the first spot away from the domestic creditors, so they are the one that should be settled first. This is why developing countries with a huge debt view rich international companies with more despise than the commercial banks. Debt equity swap could, however, bring benefit to the country debt. The reason is that repatriation of the profit usually occurs much later than the time of debt servicing, so a successful equity swap enlarges the percentage of home country's liquidity. This should not be interpreted as something that could be played against the rules by printing the new money to buy off the foreign debt. The reason is that if you print the money to start the process, you will first feel the consequences in the home country. So, even say you brought off your own debt with the new monetary mass, causing the rest of the debt on the secondary debt market to rise in its price. That leads the foreign investors to sell the debt they bought earlier, earning profit in your domestic currency. They want to repatriate the money to their own currency, causing your domestic currency to rise in price due to the demand. This boosts your own liquidity, but the inflation caused by the printing would hit your domestic market much earlier. When the country tries to block such an inflationary effect, it only turns the foreign debt into the domestic one. The domestic debt can be even a larger problem, since its interest rate usually fixates at a higher rate than the foreign ones. This then leads to a deficit in the budget and drains the foreign reserves of the country. In simpler terms, even when the foreign investor opts to sell the debt they bought off earlier, it does increase the country's total debt and reduces their chances to pay it back. It also lowers the total debt price on the secondary debt market, which makes it easier to service. Simultaneously, the process of repatriation increases the domestic liquidity, but since the first step was achieved by printing money, it all comes crumbling down when the repatriation process ends. The country is then left with a lower liquidity and higher inflation, leaving it in an even worse state to act on the secondary debt market, with the only profiters being foreign creditors. Krugman therefore fears that equity debt swap usually leads to the situation where the debt is being paid back with cash. Therefore, he proposes that overall debt should be lowered by exchanging old debts for the new ones that would be guaranteed by international institutions. He proposed his theorem to take place in the early 90s, when the developing countries owned Western commercial banks over $300 billion. That debt would be priced at around 30% value on the secondary debt market, leading Krugman to calculate that there is a 0.125% of chance of developing countries paying back their debt. The second calculation led him to a 0.875% chance of developing countries paying back 30% of their debt, ranging around $60 billion. He proposed international guarantees for a 20% or 50% of total debt during services. The first option would guarantee $91 billion of debt, leaving the creditors with $13 billion profit, while the in-debt countries would see their total debt decrease for $7.5 billion. The majority of the servicing would be paid by the guarantors, losing around $20.6 billion. The second option would guarantee 95% of the debt, which was valued around $285 billion, leaving the creditors with $52 billion profit. The in-debt countries would see their total debt reduced by $18.8 billion, while the guarantors would bear the prices of $70.7 billion. This theory is left for your discussion, while I present you the last economist who studied stagflation, Martin Weitzman. Weitzman became famous for his theorem called the share economy, with a part of the research being dedicated to stagflation. Before we delve into it, I will briefly go over Roosevelt's New Deal. The classical theorem is that inflation can be brought down by having a raise in policy interest rate. This would in turn bring down the entire economy and bring unemployment rates up, but once inflation stabilized, the effects would be reversed. Keynes' idea was that the government also played a crucial role in the Great Depression by raising the amount of aggregate demand by having a low interest rate, cheap money, welfare and public works. His idea was that the federal budget had to endure such expenses until the economy stabilizes and can be at that point cooled down by raising taxes which reduce the budget deficit. A huge change in those theorems came with the old crisis of 1970s, when inflation skyrocketed at the same time as unemployment rate. I explained this earlier in the video with the Phillips curve. Another reason behind it was that the workforce didn't behave in the same principle as capital, since it was more elastic. In simpler terms, a working person would never agree to have their wage lowered simply because the unemployment rate went up, causing the market value to go down. A common cause to this was a strong labor union that didn't agree to a wage decrease, causing the economists to declare wages non-elastic toward the negative part of the graph. Weitzman found a solution to this problem with a model that would split the company's profit between the manager and the worker. The idea was that the workers would give up a fixed amount of monthly wage and replace it with a percent of total company revenue. With this model, economic crisis and inflation would cost a reduced wage, but the manager wouldn't have to fire anyone since the company didn't acquire any deficits. Furthermore, this concept would allow the hire of unemployed workers due to the low price of work on the workforce market, and simultaneously lower the prices of goods due to the low input costs. I will show this on the example between General Motors and the labor union UAW. The current model between those has a fixed wage of $24 because the marginal expenses of the work equalize to marginal profit. In simpler terms, General Motors will hire more workers until the last marginal one that produces an income larger than $24. At any point higher than this, General Motors has no need of new workers. The total company revenue is larger, let's say $36, but the $12 have to be accounted for other capital expenses and profit. The problem is that inflation or economic crisis reduce the marginal profit below $24, causing the manager to fire workers until he reaches a point where the percent of unemployment brings profit. Weitzman suggests that managers strike a deal with the union for a percentage of company's revenue, let's say 2/3. At the current status, the wage remains $24 and seemingly nothing changes. Now, let's say that 500,000 employed generate 18 million profit per hour, with each worker making $36. 12 million would go to the workers and 6 to the managers. If Weitzman's theorem would to be introduced, General Motors would hire new workers simply because the hourly company revenue rises from the price of the marginal good of $24, leaving the total profit $18,024,000. The benefit is that the General Motors doesn't have to pay the workers a fixed hourly wage of $24, but rather pay him 2/3 of the total revenue, a total of $16. This meant that General Motors created another $6 per hour, causing it to hire even more workers. Just so you don't get confused, this doesn't mean that new workers would face lower wage punishments, but rather that all 500,000 workers lose those $8 of total wage percentage, lowering the wage for all to $23.9998. If this continued too far down, the workers would just simply start leaving for other companies. Also, since companies employed a large amount of workers, the unemployment rate would fall down to 0. This would in turn then force the managers to offer large benefits for the workers if he wanted him to stay at his workplace, and since he couldn't do it by raising pay, he would need to offer healthcare or housing benefits. In the end, this theorem would lead to better conditions of work, work benefits, and eventually worker participation in running the company by getting company shares as benefits. The closest living example of his theorem would be Japanese Sushin Koyo, where the workers are employed for life and paid based on how long they worked there. This model also pays the workers based on the company profit, usually to true annual bonuses, which are in turn close to few monthly wages. Weitzman thinks that this is why post-World War II Japan had such a low unemployment rate and highly educated workforce. This also leaves the workers free to experiment with innovations, knowing that if they fail, they won't get fired. A similar example was Great Britain during the early 20th century, where the miners were paid based on the profit that the mine made. Some US companies paid the workers based on the company profit by giving them shares. This is known as employee stock ownership plan. For the final part of this theorem, we will look how it would behave in the time of cost-push inflation. This means that inflation originates because the resource price goes up, usually due to less supply on the market. We again turn to the previously mentioned numbers. $36 of company profit, hourly wage of $24 with a peg between the union and the manager to base the hourly wage on the 2/3 on the company profit. The coefficient of demand elastic would be 3, meaning that with each percent of price reduction, the total demand rises by 3% in reverse. So how does this theorem respond if the price of aluminum rises by 50 cents per working hour? This would mean that wages went up by 2.1% because of this 50 cents base for the wage of $24. The manager would respond by having the rise of prices paid by the consumers, so the prices would rise by 2.1%. If we take the coefficient of demand at number 3, both the employment and production of the company should be falling by 6.3%. In Weitzman's model, the price of the car would remain the same even though the cost of aluminum went up. This means that employment and production remain untagged, but the price change falls on the workers who get a lower wage. This is the price they have to pay in order to keep their jobs. Weitzman, however, warns that if cost-push inflation continues, even his model cannot guarantee that prices won't rise and workers won't get fired. He admits that his solution doesn't solve all of the issues of inflation, but it sure does put an ease on its pressure. Let's say that inflation reduces the sale of cars by 10%. The usual response would be to lower the production by 10% and by firing 10% of the workers. Weitzman's model would counter this by lowering the prices by a flat 10% without touching the production or the workers. We also take in consideration that the coefficient of elasticity is 3, meaning that for each percent of price reduction increases the sale by 3%. This means that General Motors would lose 3 1/3 of the profit instead of the 10%. We got this number by dividing the 10% of demand drop with the coefficient of elasticity. When these numbers are imprinted into Weitzman's model, the wage dropped by 27 cents. This is because of $24, which is calculated as 16 plus 2 nines by 36. Workers get 16 plus 2 nines times 36 times 96 minus the 2/3, which equals $23.73. This is a flat reduction of 1.1%. This is indeed a low price that the workers pay for a guarantee that the production and employment rate won't drop by 10%. The author does further math, proving that the managers can assure profit of the company and that the workers get a larger percent of total pay, numbering $11.86 million, instead of lower total amount of employed with the same fixed hourly wage, which numbers $10.8 million. With this, we've come to an end of this video. I've presented many economical measures, which are really state economical measures to counter inflation, and I've also explained many monetary policies and how their impact reduces the inflation. I leave it to you as a viewer to decide which one you like the most and which one you think is the best. And since this video is very interesting and I couldn't fit more material into this very long video, I'm going to do a second part of this video, which is going to come out roughly 4 or 5 months after this one has been released. I hope you enjoyed it and see you in the next video.